Okay, dear students, quickly revise the corporation tax rules. First of all, when we say corporation tax, so we are actually dealing with UK resident companies. UK resident companies, it has two understandings. One, it is the company which is incorporated in UK, that is a UK resident company. Second, the company which is not incorporated in UK but centrally managed and controlled from UK, that is also a UK resident company. Centrally controlled and managed means meeting of BOD. If BOD, they are normally keeping their meetings in the UK. So we say that your company is a UK resident company. Period of account and chargeable accounting period. Generally, the period of account is 12 months long, but it could be more than 12 months. But when it comes to chargeable accounting period, chargeable accounting period can only be less than equal to 12 months. If your examiner gives you the period of account for 15 months, then you have to split that into 12 and 3. First 12 months and then additional months. When accounting period starts, when a company starts to trade, so it is the start of the accounting period. When the previous accounting period obviously ends, then it is also the start of accounting period. When an accounting period ends, it ends on the earlier of 12 months after its start, the end of company's period of account, the company ceases to be resident in the UK. When the company ceases to trade or when its profit being liable to corporation tax are ceased, any one of them occurs earlier of any four of the events. That is considered as end of the accounting period. Now, how do we calculate corporation tax? What is the format? We'll take trading profit, interest income, income from foreign sources, rental income, chargeable gain, total profit. From the total profit, we deduct qualifying charitable donation that gives us total taxable profit. Then we add dividend from non-associated companies. Non-associated companies means where your holding is less than 50%. Non-associated companies means where your holding is less than 50%, that company is a non-associated company. We add the dividend from non-associated companies to get augmented profit. Actually, tax rate is decided on the basis of augmented profit, but tax rate is applicable on taxable total profit. When it comes to corporation tax, we follow financial years. When it comes to individual, we follow tax year. Just a slight difference. When we say financial year, it actually starts from 1st April, ends on next 31st March. You are dealing with financial year 2024, which actually starts from 1st April 24, ends on 31st March 2025. Qualifying charitable donations are made gross by companies and deducted from the performer, which we have seen. Exceptions: donation allowable from trading profit and donation to political parties are not deductible. Donation allowable from trading profit and donation to political party are not deducted as qualifying charitable donation and performer. If donation exceeds the total profit, means your qualifying charitable donation is more than the total profit, unused, unrelieved donations are wasted except 75% group relief is claimed. For example, your total profit is, let's say, the total profit is, I'm just assuming 1 lakh and assuming qualifying charitable donation is 120. So normally what happens, 20,000 qualifying charitable donation will be wasted. But if your company is a part of 75% loss relief group, then unutilized qualifying charitable donation, which is in my example 20,000 pound, that could be transferred in a 75% loss relief group and utilized. But the main concept is, first you will be utilizing your own qualifying charitable donation against your total profit. Unused qualifying charitable donation can be transferred within a 75% loss relief group. The rate of corporation tax for the financial year 2021-22, the way back there was only one corporation tax, which was 19%. But from 2023 onwards, now we have got two corporation tax rate. One is 19, another is 25. When 19 is applicable, when 25 is applicable, it's very simple. A small profit rate is 19%, which applies where an augmented profit do not exceed If the company's augmented profit is either £50,000 or less than that, then applicable corporation tax rate is 19%. Otherwise, we apply 25%. A main rate 25%, which applies where a company's augmented profit are 250 or more, the upper limit. The lower and upper limits are proportionately reduced for short accounting period. For example, if your accounting period is 6 months, then this 50,000 and 250 will be prorated by simply multiplying this with 6 by 12. And also, according to the number of associated companies. Associated companies means where you have got holding more than 50%. Let's say 51% and more. So, in case of associated companies, these limits are also prorated. For example, if I say your accounting period is 6 months, so the lower limit will be 6 by 12, upper limit will also be 6 by 12. If I say in the group there are two associated companies, then further apportionment will be 1 upon 3. The question is why 1 upon 3? If you are saying there are two associated companies, actually, if there are two associated companies, then one is parent as well. So altogether in the group there are three companies. So these small augmented profit limit and upper augmented profit limits will be apportioned if the chargeable accounting, if your accounting period is less than 12 months, and they will also be apportioned in case of number of associated companies. And no matter that associated company was your associate just a part of there, not the entire year. There's a possibility during their parent has sold a subsidiary. Here, associate means subsidiary. Even the parent has sold the subsidiary in the year of disposal, you will have to consider that subsidiary as well. While prorating upper and lower limit, if during the year your parent has acquired a new subsidiary, still you will have to consider that one as well while prorating these limits. Okay. And when it comes to, of course, I would say dividend income within the corporation tax is fully exempt. Either it is coming from the associated companies or non-associated. Marginal relief. This is important. Marginal relief eases the transition from a small profit rate to the main rate of corporation tax, where augmented profit fall between 50,000 and 250. Where your augmented profit limit is between 50 and 250, then you get marginal relief. Corporation tax will apply 25%, but whatever the corporation tax comes, we will deduct marginal relief from that. How do we calculate marginal relief? Upper limit minus augmented profit. Standard fraction is 3 upon 200, and that standard fraction is given to you in exam as well. 3 upon 200. Taxable total profit upon augmented profit. But a very important point, if you come across any question where your taxable total profit and augmented profit both are same, then obviously there's no need to utilize this fraction. If you come across a question where your taxable total profit and augmented profits are same, then no need to utilize this, I would say, fraction. If no dividends are received, the final part of the, if obviously if you're not getting any dividend from non-associated companies, then there will be no difference between taxable total profit and augmented profit. Difference only arises between taxable total profit and augmented profit when the dividend is coming from the non-associated companies. Associated companies, I've given you the reference. Associated companies means you can say simply your subsidiaries, where your holding is, parent holding is more than 50%. It is possible that associated company is in overseas, still that will be considered while prorating upper and lower limits. But if it is a dormant company, then it will not be considered. So dormant companies not carrying on a trade business do not count as associate companies. No matter you have got more than 50% holding, but examiner says this company is a dormant company, means there is no trade activity at all. Then that organization, that company will not be considered while prorating, apportioning upper and lower limits. Short period of accounts, long period of accounts, we have already discussed. If your examiner says period of account is, let's say, 15 months, so you have to split that into 12 and then 3 months. First 12, then excess months. Now, how will you allocate income, chargeable gains if accounting period is 15 months? Obviously, if period of account is 15 months, you have to split into 12 and 3. Then how do we allocate incomes and charges? Trading profit before capital allowances will be time apportioned. Let's say examiner has given you the 15 months trading profit, that will be time apportioned 12 and 3 months in my example. Capital allowances you will be calculating for each period, means 12 months and 3 months. Income is taxable on accrual basis, interest receivable accrual basis. Chargeable gains, you will have to see in which accounting period it falls. If company has sold the asset in the first 12 months, then chargeable accounting period, chargeable gain will fall in the first 12 months. If that asset was sold in the last 3 months, then chargeable gain will fall in the last 3 months. So chargeable gains allocate to the accounting period. Charges on income means simply qualifying charitable donation deduct in the period in which paid. There's a possibility that in first 12 months company did not pay any qualifying charitable donation, assuming, and let's say company has only paid the qualifying charitable donation in the last 3 months. So charges on income means qualifying charitable donation deduct in the period in which they are paid. Frank investment income is the dividend income which is coming from non-associated companies, allocate to accounting period. If you are receiving dividend from non-associated companies in the first 12 months, consider in the first 12 months. If you're getting the dividend from non-associated companies in the last 3 months, then take in the last 3 months. Interest income, interest received or paid is dealt on accrual basis. Loan relationship rule is very important. Interest payable on the loan taken for trade is deducted from trading profit. If you have taken the loan for trading purposes, then obviously interest will be deducted from the trading profit. For example, company has taken the loan for working capital. So whatever interest company is paying on that loan, it will be deducted from trading profit. While interest on a loan taken for any other purposes will be deducted from interest income. There's a possibility that you have taken a loan for non-trading purposes. So question says, while interest on a loan taken for any other purpose will be deducted from interest income. So if you are, let's assuming your company has taken the loan to buy a property. So taking a loan and buy a property is not a trading purposes. You have not, it is not the loan which you have taken for a trading purposes. So while interest on a loan taken for any other purpose will be deducted from interest income. Interest received from HMRC is taxable and interest paid to HMRC is allowable for trading purposes. There's a possibility your company has paid more corporation tax than you should have paid. Then HMRC, of course, returns, and also HMRC gives you the interest also. But the rule says interest received from HMRC is taxable. And if you are paying late corporation tax, so you will be paying interest also. That interest is a deductible expense. Loan relationship deficit, a very important point, non-trading interest income, less non-trading interest expense. If the final answer is positive income, net interest income, just include that in the main performer. If it is deficit, means your expense is more than the income. If the interest expense is more than the interest income, then how to utilize the deficit? Non-trading interest expense, there are 4 options to utilize. Option 1, set up against the total profit before qualifying charitable donation in the current period. If you are having a deficit, one of the option is you can utilize that deficit against the current accounting period. Total profit before qualifying charitable donation. Another possibility, carry back against interest income. This is important. Look at this, student. In the current year, what is happening? Set off against the total profit before qualifying charitable donation in the current period. But when we say option 2, carry back interest income for previous 12 months, carry back against interest income. If you want to go for carry back, then you will not be deducting the deficit against the total profit, then you will be deducting the deficit against the interest income of previous 12 months, or if it is the last year of your business, then you can carry back for 36 months. But the important concept rule is if I carry back the deficit, I'll be deducting the deficit against the interest income. There's option 3 also. Carry forward against any non-trading profit of the future period. If you want, you can carry forward also. But in that case, you can deduct the deficit against the profit which is coming from non-trading profits, like it could be chargeable gain, property income, things like that. One more option is available, which is group relief. If you are a part of 75% loss relief group, then deficit can be transferred within a 75% loss relief group. Partial claim is allowed, so company has the option to relieve the losses as it wants. Dividend income is fully exempt. We have already considered either it is coming from associated companies or non-associated. Property income. Property income is calculated on accrual basis. If you recall, when we study the property income for individuals, the default category is cash basis. But when we are studying property income for corporations, then property income is taxable on accrual basis. For chargeable accounting period, interest expense on a loan to buy rental is deducted from interest income, not property income. So we have already discussed, if your company has taken a loan to buy a property and let's say you have given that property on rent, whatever interest you are paying on that loan, you will not be deducting that interest from the property income. You will be deducting interest on that loan against the interest income. There is no rent or room relief for the companies. Property loss must be deducted from total profit before qualifying charitable donation of the current period, and any remaining loss will be deducted from future total profit before QCD. Partial claim is not allowed. How to utilize the property loss? Property loss must be deducted from total profits before qualifying charitable donation of the current period, and any remaining loss will be deducted from future total profits before QCD. Partial claims are not allowed, and this is format for the how to calculate taxable trading profit. Profit from financial accounts, add back disallowable expenses, add taxable income which is not included, less allowable expenses, less disallowable income, like if there's any property income, chargeable gain, we will deduct that because we just want to see what is your taxable trading profit. Private use by owner and employee both are allowable when it comes to corporation tax. Logically, in case of corporation tax, there is no concept of privately used asset. Dividend payable by company is not an allowable trading expense. Capital allowances. Capital allowances, no private use asset column because private use by owner is allowed. If period account is more than 12 months, we have already discussed, you have to split that into 12 annexes. And for each chargeable accounting period, separately, you will have to calculate capital allowance. Only one AIE is allowable to group of companies. However, AIE can be shared between annual investment allowance limit is 1 million, but it is only 1 million is available to the entire group. But obviously, it is up to the group how they want to utilize it. A related company, only one AIE 1 million is available to related companies. Companies involved in the same activities or share same premises, which are owned by the same individual and owner of the companies can allocate it. So in case of related companies, you will be getting only one AIE. If they are unrelated companies, then each company will separately get annual investment limit of 1 million. How to utilize the trading losses in case of corporation tax? Carry forward and deduct from the first available total profit of future years. Carry forward and deduct from the first available total profit of the future years. Set off trading loss against total profit. You can do one more thing. You can deduct against the set off trading loss against the total profit. Deduct trading loss from the total profit before qualifying charitable donation of the current year. Only then deduct the remaining loss from the total profit before QCD of previous 12 months. There's no limit. There's no cap. A very important concept is in case of corporation tax, you cannot directly carry back the loss for 12 months. First, you have to utilize the loss against the current year total profit. After that only, remaining loss can be carried back for 12 months. You cannot directly go for 12 months carry back. Terminal loss is the loss of last 12 months of the business. If the trading loss arises in the last 12 months of the trade, then this loss can be set off against the total profit of previous 3 years on a LIFO basis. Partial claim is not allowed. Restriction on trading loss. The restriction applies in two situations. Okay. The important point is if the restriction is applicable, then you won't be able to utilize the losses. How? Let me explain. Where there is both, a change in ownership means someone, parent has changed. Where there is a both, a change in the ownership and a major change in the nature or conduct of the trade. Assuming parent has acquired, assuming A Limited has acquired B Limited. A has got more than 50% holding in B Limited, number one. Number two, parent says that B Limited was not trading, was not doing business in, let's say, Sri Lanka. But after we get the control, now B Limited will operate in Sri Lanka as well. Previously, they were not operating in Sri Lanka. So it's a major change. So two things are happening. There's a change in ownership as well as there's a change, major change in the nature and conduct of the business. In that case, what happens? The loss which was there in the B Limited before the change of ownership and change of nature and conduct of the business, that loss cannot be utilized against the profit which arises after the change of ownership. Where there is both a change in the ownership and a major change in the nature or conduct of the trade within 5-year period, beginning no more than the 3 year before the change in ownership, or when at any time after the scale of activities of trade has become small or negligible, and there are any considerable revival of the trade, there is a change in the ownership of the company. For example, B Limited profit trade has become very small, and before the revival, someone else has taken the control of B Limited. In that case, if after someone has taken the control of B Limited, then B Limited starts after some time making profits, you cannot utilize the loss. B Limited cannot utilize the loss against the profit which arises after the change of ownership. Restriction losses before change in ownership cannot be deducted from the profit which arise after the change in ownership. Losses after change in ownership cannot be deducted from profit which arise before change in ownership. Change in nature or conduct means major change in property dealt in service or service provided, customer, product. I've given you the example. Like previously, they were not dealing in Sri Lanka, but now the new parent says, no, we will also be dealing in Sri Lanka as well. Previously, company was not dealing online. Now the company says we will be dealing online as well. Okay, foreign income. Any foreign income must be included in taxable total profit. Foreign income is gross up by foreign tax suffered. So if there is any foreign income on which, let's say, you have paid around 10-15% tax, first you have to gross up that foreign income. After grossing up, the gross amount of the foreign income will be added to the main format, but don't worry at all. If on any income you have paid tax in overseas, so you will be getting a double tax relief as well. No matter either there is a double tax treaty or not. Okay, chargeable gain. Students, when it comes to chargeable gain, you just need to know one thing. In case of corporations, there is a concept of indexation allowance, but indexation allowance is only available on all those assets. Number one, they are chargeable. Second, they were bought before December 17. No matter whenever they are sold, but the main concept is assets, they are chargeable. Second, asset they were bought before December 17. Then, if you are selling them after December 17, indexation allowance is applicable from the date of purchase till December 17. After December 17, there is no indexation allowance. Okay. Look at the format: disposal proceed less incidental cost of disposal, net proceed, allowable cost, unindexed gain, indexation allowance, chargeable gain. You just need to know one thing. that indexation allowance cannot create loss as well as it cannot increase loss. For example, look at this unindexed gain. If instead of unindexed gain, there's already a capital loss, then from the capital loss, you cannot deduct indexation allowance to increase the capital loss. So indexation allowance cannot actually increase capital loss, number one. Number two, it cannot also create capital loss. For example, unindexed gain is £1,000. Assuming indexation allowance is 1200. So from 1000, I'll deduct 1200, but I'll be writing 0. Indexation allowance cannot increase as well as create capital loss. Disposal of shares and securities, we have to follow the matching rule. Matching rule is little different for the companies. Shares acquired on the same day, then shares acquired in the previous 9 days, and shares in the pool. All those shares which were acquired before the previous 9 days, they will be in the pool. On disposal or acquisition of shares, indexation allowance is added in the cost, provided that they were bought before December 17. Bonus is free of cost, so due to bonus issue, number of shares will increase without any change in the cost. Right issue will increases the shares as well as cost because rights, they are not in free. In case of corporation tax, only one relief is available, which is rollover relief. Rollover relief is the only capital gains relief available to companies. It allows the deferral of index gain. Index gain is the gain which is after indexation allowance. Index gains arising on the disposal of qualifying business asset. All rules for rollover relief are same as individual except the qualifying asset for the companies are land and building used in the business, number one, fixed plant and machinery. Goodwill is not a qualifying asset for the roll. This is important. Goodwill is not a qualifying asset for the rollover relief. Capital losses are relief against current year capital gains, then capital gains of the future chargeable accounting periods. Capital losses are relieved, utilized against the current year capital gains, then capital gains of the future chargeable accounting period. Transfer pricing legislation, student, more than I would say once it has been examined in the past papers. Transfer pricing legislation. You just need to know one concept. If the transfer pricing legislation applies, then you have to just bring the transaction at fair value. Because, okay, then when I'm going to bring the transaction at fair value, then what happens? Then profitability of one organization will increase and the profitability of another organization will reduce. There's a possibility that parent has deliberately sold the goods to the subsidiary at a very lower price. Due to that, profitability of parent, it has reduced and the profitability of subsidiary has increased because deliberately parent has charged a very low price. If the transfer pricing legislation applies, then we will bring that transaction at fair value. When I'm going to bring that transaction at fair value, then profitability of the seller, parent, will increase in my example, and cost of the buyer, subsidy, will increase, and the profitability of subsidy will reduce, and the profitability of parent will increase. It is applicable upon transaction between connected companies, means parent and subsidiaries, and subsidiary and fellow subsidiaries. Companies are connected if one company directly indirectly participate in the management control capital of the other company, or a third party directly indirectly participate in the management. Large companies, transaction with any company. If it is a large company, okay, if it is a large company, transfer pricing rule applies. Okay, we know that large company is a company where your augmented profit limit is exceeding 1.5 million. But let me tell you one thing. When it comes to ATX exams, your examiner, when it comes to transfer pricing rule, is very helpful. It will be categorically mentioned in the question either the company is a large company or it is a small or medium company. Large company transaction with any company, transfer pricing rule applies. If the transfer pricing rule applies, then transaction between the related parties are recorded at arm's length prices, means fair values. A small or medium company, transaction with overseas company resident in a non-qualifying territory. If your company is a small or medium-sized entity, you are having transaction with overseas companies. They are not overseas companies resident in non-qualifying territory. If they are in non-qualifying territory, again transfer pricing rule will apply. Now, what is the meaning of non-qualifying territory? Non-qualifying territory is one in which UK has no double tax agreement, has no double tax treaty agreement. Transaction with UK SMEs or overseas companies resident in the qualifying territory, transfer pricing rule not apply. So no need to bring the transaction at fair values. Simply, if it is a large company, transfer pricing rule will apply. If it is small or medium-sized company, but there are transactions with overseas companies which are not resident in the qualifying territory, again transfer pricing rule will apply. Goodwill and intangible non-current assets. Expenditure relating to intangible asset other than goodwill. For example, patents, copyrights, trademark, brands, intellectual property, and know-how. Now you have got two options. You can follow one of them. Use deduction made under the accounting rule. Research will deduct. Amortization impairment. Elect to disapply accounting deduction. Claim 4% on a straight line. Now listen. Basically, other than goodwill, if you have got any intangible asset, you have two options. One, go for accounting amortization, or you can elect to disapply accounting deduction and claim tax allowable deduction by using 4% straight line. Now the question is, uh, in case of intangible asset other than goodwill, I can follow the normal accounting rule of amortization, or even I can elect to disapply the accounting deduction. I can go for 4% straight line allowable expense. So which one should I use? It's very simple. If, for example, under accounting rule, one possibility you are not amortizing it at all, it means there's no allowable expenditure under accounting rules, then I'll go for 4% straight line method. Second, there's a possibility that under accounting rule, assuming your amortization percentage is just 2%, then obviously I'll go for 4%. So simply how to decide? Simply you will have to compare accounting rule, compare with 4% straight line. Whichever gives you a higher deductible expense, go for that. But you have to elect one of them. Election for the choice of treatment is irrevocable and should be made within 2 years from the date of acquisition of the asset. So you have to be very careful to opt any one of the method. But once you have opted, it is irrevocable election. If a company disposes of an intangible asset, then profit or loss will be difference between the disposal proceed and carrying amount. Very important concept. If a company disposes of an intangible asset, then profit and loss will be the difference between sale proceed minus the carrying amount. Carrying amount means original cost minus all the allowable expenses. For example, you have already amortized that asset for 3 to 4 years. So from original cost, you will deduct all the accumulated amortization. Then you will get carrying amount. So from the sale proceed, we will deduct the carrying amount. Company has the option to elect to roll over the trading profit upon disposal of intangible asset if disposal proceeds are reinvested within 1 year before or 3 years after disposal. If company has sold the intangible asset and there's a profit on that intangible asset, if company wants, they can get the rollover relief, provided that within a qualifying period you have reinvested the money in another qualifying intangible asset. Tax treatment of goodwill. No amortization, impairment on goodwill are allowable for tax purposes. On a disposal of goodwill, profit is taxable as trading income, but loss is non-trading loss, which can be very important. Tax treatment of goodwill. No amortization or impairment on goodwill are allowable for tax purposes. On a disposal of goodwill, profit is taxable as a trading income, but loss is a non-trading loss, which can be set off against the total profit of the current period. Carry forward, deduct from the non-trading profit of the next period. Even it can be transferred to a 75% group relief if you are a part of 75% group relief. A special intangible rollover relief, this is also important. If a profit is made on disposal of any intangible asset and new intangible asset is acquired within 12 months before or 36 months after disposal, part of the taxable profit may be deferral. This is important. Part of the taxable profit may be defer. How to calculate? The maximum deferral is equal to lower of disposal proceed or amount reinvested. Assuming disposal proceed is 150 or reinvested is 140. So for me, the relevant is 140. But from this 140, you will deduct cost of the original intangible asset. Assuming original intangible asset cost was 120. So you will get deferred relief how much? 20,000 from the chargeable gain. So look at this. The maximum deferral is lower of disposal proceed. Assuming disposal proceed is 150, amount received is 1, amount reinvested is 140. So the lower one is amount reinvested. Then from amount reinvested, you will deduct cost of the original asset. Then you will be getting a maximum deferral relief amount. For example, the gain was 70. From that 70, you will deduct 20. Special intangible rollover relief is available for goodwill as well as other types of intangible assets. Now, this is important, student. SSE. First of all, whenever one company is selling their holding in another company, you should immediately think for SSE. Repeat. Whenever one organization is selling their holding in another company, you should be thinking for SSE. The main concept is if SSE is applicable, then capital gain is exempt, then simply there will be no gain, no loss. Substantial shareholding exemption. Substantial shareholding is a holding where your holding is 10% or more in another company, which are owned for at least how many months? 12 months out of 6 years before the date of disposal. For substantial shareholding exemption, both investor and investee companies should be trading companies. Gain on disposal of shares out of substantial shareholding is exempt and loss is not allowable. If disposal of shares qualify for SSE, remaining shareholding, if it falls below 10%, then you should be selling it within next 5 years. In order to determine substantial shareholding, shares held by the connected companies will also be considered. If there is a share for share exchange, then the combined period of ownership, both previous and the new one, will be considered to determine a minimum period of ownership. SSE will be available if the shares are not owned for 12 months. If the shares being disposed are in a new company, there's a possibility that you do not have the ownership period of even 12 months. Still, you are getting SSE. SSE will be available even if the shares are not owned for 12 months. If the shares being disposed of are a new company and the new company receives asset from another 75% group company and the asset transfer were held and used in the trade for another group for 12 months before the transfer. Now, what is happening? Number one, the shares being disposed are in a new company. And how new company got assets? New company has got asset from another group member. And that group member who has actually transferred the asset transfer were held and used in the trade of another group company for at least how many months? 12 months before transfer. Research and development expenditure. Actually, in UK HMRC, they encourage organization to spend money on R&D. That is why they come up with this solution so that corporations, they are spending money on R&D, they should be getting some relief. In order to encourage more spending on research and development, additional tax relief is given if the company spends money on qualifying R&D, as defined by the generally accepted accounting principle and guidelines from Department for Business. R&D rule, let me explain. Come here. Look at this. Gull Limited spent 2,40,000 on qualifying R&D revenue expenditure in the year ended March 25. This amount is not included in the following results. 240 they have not included. Trading profit adjusted for the tax but before R&D is 850. Chargeable gain is 20. Calculate the corporation tax payable by Gull Limited for the year ended March 25 and total amount of corporation tax saved by claiming what R&D expenditure relief. First, trading profit before R&D, then simply deduct qualifying R&D expenditure. Then the rule says whatever is your expenditure which you are deducting for calculating profit, trading profit, simply add 20% of that. First, technically, we're deducting 100% of R&D. Then we are adding back 20% of that. Now, the question is, what is the benefit by doing this? Just wait. First, obviously, you have to deduct R&D. Then add 20%. It gives you trading profit 6,58,000. Then chargeable gain is 20. Taxable total profit is this. Obviously, it is more than 250. So applicable corporation tax rate is 25%, no marginal relief. 6,75,000 to 25%. Then deduct the same amount which you have added as 20%. So corporation tax is 1,21,500. Now the question is, what benefit we are getting by doing this? Let me explain the benefit. If you really want to see the benefit, you can do one thing. Just ignore R&D at all, and let's see what corporation tax liability comes. Trading profit before R&D is 850. Trading profit before R&D is 850. I'm just ignoring R&D. Chargeable gain is 20,000. So your total taxable profit is 770 because 870. There is no so simply we'll apply 25% of that. What I'm doing, I'm just ignoring R&D altogether. I'm getting 2 lakh 17,500. So if there is no R&D at all, your corporation tax liability would have been 2,17,500. But now, due to R&D and the rule of HMRC, the corporation tax liability is coming 121,500. Let's see how much corporation tax we are saving due to R&D. We are actually saving 96,000. How did I calculate 96? Just ignore R&D and calculate corporation tax liability. Just ignore R&D and calculate corporation tax liability, then compare that corporation tax liability with the liability which you have calculated by considering R&D. So you will automatically get to know how much your corporation tax is safe. Now here there are alternative ways of to getting the same thing, but to me, I think the first, I always find this method easier. Just ignore R&D and calculate corporation tax. But if you want to follow any other alternative, which I have given in my notes, it's up to you. Qualifying expenditure. Qualifying R&D expenditure must be revenue expenditure on a project that seeks to achieve an advance in science or technology that is relevant to the company's trade. It can include expenditure on the following: staffing costs for staff directly involved in R&D work, including NIC class 1 employer. Pension contribution, but excluding what? Taxable benefit. Externally provided workers, agency staff for R&D, material, water, fuel, power for R&D, software, data licenses, cloud computer service directly used in R&D. Payment to subcontractor, it cannot include rent. Payment to external workers and subcontractor. Usually it is the company that decides to carry out R&D that makes the claim for relief. Although work may be subcontracted to another, you can even outsource the work. Where payments are made to unconnected external workers and contractors, only 65% of the expenditure will qualify for enhanced tax relief. If R&D is contracted to a connected person or a company, then R&D tax relief can be claimed on the lower of the payment made to the connected contractor and the relevant expenditure. Two companies are classed as connected if either both companies are controlled by the same person or one company controls another. Capital expenditure, just see this. Capital expenditure on R&D excluding land qualifies for 100% R&D capital losses in the year purchased, so fully deductible as trading expense. It does not, however, qualify for R&D EC. When the capital assets are sold, the proceeds are treated as balancing charge and therefore tax as trading income because you have already taken 100% capital allowance. Now look at this question. DEX PLC is a profitable company manufacturing audio visual equipment. The company has recently decided to investigate the market for a new type of classroom projection equipment and has spent the following amount on the project. In the year ended 31st December 2024, we have got market research, staff directly involved in research, administrative support for R&D, heat and light for R&D, rent, plant use for R&D, new software, payment to unconnected external contractor. R&D expenditure incurred by external contractor was 50. Advise DAX PLC of expenditure qualify for R&D if no election is made. Explain how this will differ if DAX PLC external contractor elect to treat as connected. Look at this. Market research, not a direct R&D, so 0. Admin staff support. Staff which is involved in the R&D is an allowable expense. Admin staff does not fall in R&D. Heat and light, yes. Rent, not qualifying for R&D. Plant 100% first year allowance, not R&D. Software, on plant you will get 100% capital allowance. It will not, but it is not a part of R&D. Software 4,000. Payment to subcontractor is whatever payment you are paying, 65% of that. So qualifying research and development expenditure is 98,000. The cost of market research, admin support and rent all are allowable expenses, but not qualifying for what? Because the expenditure which qualifies for R&D, what do? We add 20% of that while calculating taxable total profit. Then we calculate corporation tax liability, whatever comes from that corporation tax liability, we deduct the 20%, we deduct the same amount which we have added. So the amount which qualifies for R&D will add 20% of that to the simply taxable total profit. Then we'll calculate corporation tax liability. Whatever comes, we will deduct the tax credit, the same 20% of, let's say, qualifying RDEC. If election is made, if DAX PLC external contractor elect to be treated as connected, then R&D can be claimed on the lower of 1 lakh, the payment to the made to the contractor, and 50,000 relevant expenditure of the contractor. Therefore, only 50 will be eligible for R&D instead of 65, so the election is not beneficial. R&D expenditure, look at this. If that company becomes your connected person, then lower of 1 lakh, the payment made to the contractor and the relevant expenditure 50. So therefore only 50 will be eligible for R&D instead of 65. So election is not beneficial here. A student, this is, you have to just read it once. Equity finance, debt finance, sole trader, company. If someone wants to extract the funds from the company in the form of salary, so what are the tax consequences? If someone is taking the money from the company extracting the money in the form of dividend, what are the tax consequences? Normally it happens, should I take money in the form of salary or dividend? Normally it happens when I'm a simply shareholder of a closed company and I'm working as well. Then I'll be thinking, should I get the money from this company either in the form of salary, bonus, or should I go for dividend? So you need to know the consequences, just read it once. A rental income from a company. Individuals should try to own the asset if the company on the company. Individuals should try to own the asset of the company instead of owning asset through the company. In this way, individual will be able to withdraw profit after tax from the company in the form of rental income. So if you are the owner of an asset and a company as well, try to not to own the asset through a company, try to own that asset by yourself and give that asset on rent to the company. This will be liable to income tax as property income, but company will be able to claim allowable deduction in respect of the rent paid for the property from the trading profit. So you are the owner of the property as well as a company. So you should buy that property first, give that property on rent to the company. Obviously, company will pay you the rent, and whatever rent company is paying for company, it is an allowable expense. If asset is being used in the trade, such a manner as mentioned above include individual can avoid double taxation at the time of disposal of asset. However, BPR would be reduced to 50% for the IST purposes. So interest income from the company, again, just read it once. Now this is important. Closed company. Closed company is a company where less than equal to 5 shareholders are having control. Company controlled by 5 or less shareholders. That is a control company. That is a closed company. But if all the shareholders are the directors, then it could be any number. It could be 5, 7, 8, 9, then any number. So normal, a basic simple concept of the closed company is a company where less than equal to 5 shareholders have got control. But all the shareholders, if they are directors, then there is no restriction of the numbers. Rule which we need to know is, if I'm a shareholder and an employee of a closed company and I'm getting a benefit from the company, so how will I pay the tax? Provision of the benefit from closed company to an individual who is a shareholder and a director means employee. For directors, it will be taxable benefit liable to income tax calculated by using normal rules of employment income. So if you are a shareholder as well as a director of a closed company and you're getting any benefit, like you're getting a benefit of car accommodation, so normally we'll apply employment income rules and we'll get the taxable benefit. For companies, cost of providing the benefit will be allowable expense. We know that. Provision of benefit from a closed company to an individual who is just a shareholder. Now the question is, if you are a shareholder of a closed company and closed company has given you the car for the personal use, normally it is only possible in case of a closed company. Otherwise, you will not be getting a car from your company where you are just a shareholder. So if you are a shareholder of a closed company and they are giving you the benefit, but you are just a shareholder, then what to do? For individual, it is dividend income equal to the taxable value of the benefit calculated using employment income rule. So whatever benefit in kind you are getting, because you are a shareholder of a closed company, so we will apply the employment income rules. We will calculate taxable benefit. That taxable benefit will be treated as dividend income for the shareholder. For the company, it will be assumed that company has paid dividend equal to the value of taxable benefit. Loan taken by shareholder to make a loan or purchase share of a closed company. If you are taking a loan to buy or to give loan to a closed company, or you buy shares from a closed company, then such a loan is a qualifying loan. And qualifying interest is actually deducted from the total income rather than any individual income. Benefit in respect of interest: if company provides loan to an employee less than 2.25%, if individual is a shareholder, it will deem to have been received the dividend equal to the value of taxable benefit, which will be calculated using employment income rule. If closed company has given beneficial loan to a shareholder who is just a shareholder, we will simply calculate taxable benefit by using employment income rules. We'll be using average method, accurate method, whichever gives us a lower taxable benefit. That lower taxable benefit will be treated as dividend income for the shareholder. If an individual is a shareholder and director, then it will be taxable benefit for related individual. Loan from a closed company to its shareholder only, or shareholder plus an employee. Now what is happening? Closed company is giving loan to the shareholder, or that person could be shareholder plus employee. Then what happens? Tax charge. If a closed company lends a loan to its shareholder, then company has to pay tax charge 33.75% upon the amount of the loan. Due date to pay tax charge is the same as the due date to pay corporation tax, for example, 9 months and 1 day or quarterly basis. No tax charge will be due by the company if individual repays the loan before the due date. So simply, if you are a shareholder or shareholder plus employee of a closed company and closed company has given you the loan, then whatever is the amount of the loan multiplied by 33.75%, tax charge company will have to pay to HMRC. And the payment date is the normal when we pay corporation tax. Exemption from tax charge, student, this is very important. When no tax charge will apply, no tax charge will arise if following three conditions are satisfied. Amount of the loan is less than equal to 15,000 pound. Individual is a full-time employee of the company. Individual owns less than equal to 5% of the shareholding of that closed company. If all the three conditions are met, if all the three conditions are met, then there will be no tax charge. This tax charge is refundable into a situation when the shareholder repay the loan to a company. When shareholder repays the loan to the company, then HMRC refunds the amount to the company. When the company writes off the loan into its own books, when the company write off the loan, then again HMRC will return that amount to you. And a very important concept is when company writes off that loan amount, then it becomes dividend income for that shareholder. Amount loan written off by a company will be treated as dividend income of a shareholder. Loan written off will not be an allowable expense for the company because it is treated as dividend income. And then obviously individual will have to pay tax on that dividend income. Companies with investment business. Companies holding investment are called companies with investment businesses. Management expenses of a company is allowed to be deducted from total profit before QCD of the current year, and unutilized management expenses will be carried forward against the total profit of future year. One possibility, or company can choose to transfer the unused management expenses to 75% group member. You can do that also. Management expense includes remuneration of employee, audit fee, bank interest, head office, overhead commission, office rent rates, this, that. Students, 75% loss relief group. Just listen carefully. In order to be 75% loss relief group can only be, you can only be a member of a 75% loss relief group when the direct holding is 75%. At each level, the holding has to be 75, and even the effective holding of the ultimate parent must be at least 75%. Overseas companies, they can be a part of 75% group relief, but they cannot get the benefit from the group relief. Tax implications. Surrendering company can transfer current year trading loss, no need to claim against its own profit first. Non-trading interest expense, no need to claim against its own profit. But when it comes to qualifying charitable donation, unused means surrendering company is a company which transfer their losses to the 75% loss relief group. You can transfer your unutilized qualifying charitable donation. You can transfer unutilized property business loss. You can transfer unused management expenses if you are an investment company. Surrendering company can transfer brought forward trading loss, non-trading interest expense, management expenses. Only corresponding period losses are eligible for relief. Corresponding period means matching period. Claimant company. Logically, claimant company is going to utilize first their own brought forward trading losses against their total profit. After that, they will be accepting losses from the surrendering company on the basis of common period. Consortium. When two or more companies, UK or overseas, mutually own 75% shareholding in another company, provided each company owns at least 5 but maximum 74. For example, we have got A Limited having 40% holding in B Limited. We have got C Limited having 35% holding in B Limited. So basically, B Limited is a consortium company. A and C, they are consortium members. A and C, they cannot transfer losses to each other, but B Limited, which is a consortium company, they can transfer losses to A Limited according to their holding. B Limited can transfer their losses to C Limited according to their holding, which is 35%. Another possibility, A Limited can transfer its own loss to B Limited, again according to the holding. For example, if B Limited is having a loss, assuming 40% of that loss, which is 40,000, can be transferred to A Limited, and 40% of that loss can be, or 35% of that loss can be transferred to C Limited, provided that A and C, they are having taxable total profit more than that. In case of A, is having taxable total profit more than 40, C is having profit more than 35. Now there's a possibility that A is having a loss, C is having a loss, consortium company is having a profit. Assuming consortium company is having taxable total profit. I'm just assuming 2 million, 2 lakh. Now what? How much A can transfer the loss to B? If I take 40% of this, which is 80. So A can maximum transfer the loss to B is 80,000. A can transfer less than that, but A cannot transfer more than that. Similarly, if I say how much C can transfer loss to the B Limited, you will take 35% of 2 lakh, which is 70,000. So you can say that C can maximum transfer 70 to B or less than that. So you have to be careful. Either the consortium company is having a loss or income. Either you are transferring losses to the consortium company or consortium company is transferring losses to you. Again, overseas companies can become a part of consortium arrangement, but they cannot get the benefit. 75% capital gain group. How do we make 75% capital gain group? Where direct holding of the parent has to be 75. At each level, the holding has to be 75, but effective holding of the parent must be more than 50. Again, overseas companies can be a part of 75% capital gain group, but they won't be able to get any benefit from this group. Under the 75% capital gain group, current year capital gain and losses can be transferred. Another implication, if assets are sold within 75% capital gain group, they will be sold at no gain, no loss. Degrouping charge is a concept of degrouping charge. It can arise if 75% gain group member leaves the group and still holds an asset which it had received from another 75% group member via no gain, no loss transfer. It will be calculated market value at the date of original intra transfer minus original cost plus indexation allowance, degrouping charge. But logically, the degrouping charge will not arise if SSE, substantial shareholding exemption, is available. Charge is taxable to transfer company. However, it will be exempt in case of substantial shareholding exemption. Transfer company can choose transfer degrouping charge to another 75% gain group. Simply, if SSE is applicable, then there is no degrouping charge. Stamp duty. Stamp duty land tax is exempt on transfer between 75% gain group companies, but exemption will be written off if receiving company leaves the group within 3 years from the date of intra group. So there's an exemption of stamp duty land tax on transfer between 75% gain group. But if that company is leaving the group within 3 years, then you have to pay SDLT. Pre-entry capital losses. Capital losses of a company before joining 75% gain group can be offset against gains from disposal of asset before joining the group, from disposal of asset which were owned before joining the group and sold after joining the group, from disposal of asset which were acquired after joining the group and sold to third party. Transfer of a trade within a group. We have got A Limited, B, C. Transfer of asset from B Limited to C. B is transferring their trade business to C. Special rule apply because this is a gain group. Now what happens under a special rule? Try to understand A is the parent, B and C they are subsidiary. B is transferring entire business to C. We're not selling the B. We're just transferring the business of B to C. It's a capital gain group, so special rule applies. Under special rule, what happens? Trading losses. Transfer with the trade and deducted from the future trading profit of C. Capital allowances. Plant and machinery will be transferred at written down value. There will be no balancing charge, no balancing allowance for transfer, no AIA first year allowance to the transferee, means C. Mr. A, owner of B and C. Now B is transferring entire business to C, but it's not a capital gain group. Transfer asset from B Limited to C, special rule apply, but this is not a gain group. Same person owns more than 75% trade at some point within 1 year before the transfer. Now look at this. Capital gain. If gain group assets are transferred, no gain, no loss. If no gain group, capital gain loss will arise. Overseas OSPEC, UK resident companies. Actually, UK resident companies, they are required to pay tax on their worldwide income. If you have got any permanent establishment, means overseas branch, and if you don't want to pay corporation tax on that overseas branch, then you have to make the election. But that election will be an irrevocable election, and once you have made the election that I will not be paying, that my company will not be paying corporation tax on their overseas branch, then in the future, no matter how many branches you are opening in different countries, exemption applies on each and every branch. Overseas subsidies branch, you have to just read it once. You just need to know one thing, that overseas branch is not a separate legal entity, but overseas subsidy is a separate legal entity. If you go for exemption of overseas branch, an irrevocable election can be made for exemption of profits of overseas branch. In this case, branch profit, trading interest, rent, capital gains are exempt from UK tax. No loss relief available, no capital allowance is available. If election is made, it will be irrevocable and will be applicable to all overseas branches. Now, student, final concept of corporation tax, control foreign company, CFC. An overseas resident company will be CFC if controlled by UK resident companies, and or individual, and has incorporated or acquired artificially diverted profit from UK. So if there is any controlled foreign company, HMRC thinks that those companies, they are controlling overseas companies, they have actually artificially transferred the funds from the UK to overseas. That is why CFC charge arises. CFC charge arises only on corporations, does not apply on individuals. On individual, no CFC. UK resident company control owns CFC can be controlled by more than one UK resident companies, in which case each company must own at least 25%. CFC charge will arise on UK resident companies. How to calculate? CFC charge. Amount of CFC chargeable profit caught by CFC legislation, which will be given to you in exam, multiply by your holding into main rate, means 25%. Whatever the amount comes, then you will be deducting a double tax relief, is the tax which you have paid in lower of. Double tax relief is lower of tax paid in overseas and tax in UK. Then we have got chargeable profit. Income from CFC. CFC will have no chargeable profits. Income from CFC but not chargeable gain that are artificially diverted from UK. So simply examiner, most of the time examiner directly gives you the chargeable profit. Don't worry at all. Just you need to know one thing. Exemptions to CFC. Exempt period exemption. No CFC charge will arise in the first year, first 12 months. If CFC is in the second accounting period and if it is CFC in the second period and no CFC charge arises in the second period, then your first period will also be exempt. Excluding territories. CFC is resident in an excluding territory. Territory approved by HMRC where rate of the corporation tax is even higher than the UK corporation tax. Lower profit. The CFC taxable total profit is less than equal to 5 lakh, of which non-trading is less than equal to 50,000. Again, no CFC charge will arise. Lower profit margin, CFC accounting period profit is less than equal to 10% of the relevant operating expenditure, or simply tax exemption. If CFC has paid the tax, which is equal to the tax paid in overseas countries at least 75% of UK corporation tax. For example, in overseas you have paid £15,000. In UK your tax is coming 20,000 on that overseas income. Of course, if you have paid 15,000, which is 75% of 20,000, then no CFC charge will arise. The tax paid in the overseas countries at least 75% of the UK corporation tax, which would be due if the CFC were UK resident company. If that company was a UK resident company, let's say your corporation tax would have been assuming 20. You have already paid 15,000 in overseas, which is 75% of 20,000. So now no CFC charge will arise. Student, reconstruction, reorganization is exactly the same like individuals. Liquidations rule, you have to just read it once. When the capital repayment rule applies, and very important point is If capital repayment rule does not apply, then whatever income is coming, it is treated as dividend income. And I think in the previous class, we have discussed this capital rule. Personal service company students, you have to, I would say, memorize the format. That there is one individual who has set up the entire company, and that individual is in its their personal capacity providing the services. Then IR 35 rule applies, but you have to memorize this format. Another thing is service provided by a personal service company to a medium or large size organization. If I am providing services to the medium or large size organization, then it is the responsibility of that client to determine the personal service company status and calculate the direct deemed direct payment. And on that deemed direct payment, they will be calculating income tax and everything. Service provided by a personal service company to a medium or large size organization. In this situation, it is client rather than personal service company which is responsible for deciding the status of individual. The client will issue the status determination statement to the individual, where it is determined that IR 35 rule applies. The client is then required to calculate and pay income tax and an NIC on the deemed direct payment. So there are two different things, student. One, you are providing services through personal service company, and your client is not a medium or large size organization. IR 35 is applicable. If your client is medium or large size organization, then they will determine your status of personal service company. They will calculate deemed direct cost. On that deemed direct cost, client will pay income tax as well as NIC. So students, I would say this was a entire rules of corporation tax we have covered, I think, within 1 hour, and I would say maybe 40 minutes. Not, in fact, not 1 hour. I think we have covered 1 hour and 10 minutes. So within, I would say, 70 minutes, we have revised the entire corporation tax. So thank you very much for watching this lecture. Just by spending 70 minutes, we have revised the entire corporation tax. Thank you very much. Hope to see you all and others in the next class as well.